The Fed needs a bailout. I'm your host, Steve Metre, and thanks for joining me today. And Congress will be forced to bail out the Fed as the central bank is now broke. Let's over to Bloomberg, where we picked today's story up with a headline: the Fed is losing billions, wiping out profits that funded spending. The central bank around the world is paying more in interest, and governments may need to make up holes at central banks. The bond market is enduring the worst sell-off in a generation, triggered by high inflation and the aggressive interest rate hikes that central banks are implementing. Falling bond prices in turn mean paper losses on the massive holdings that the Fed and others accumulated during their rescue efforts in recent years. But that's not the issue. The Fed actually buys and tends to hold bonds to maturity. So if they go down in between the time they roll them off, assuming they actually are going to roll all of them off, and we know that's not going to happen, the fact that interest rates have gone up and bond prices go down has not impacted the Fed. But what has is the fact that it's paying out more than it's bringing in. Rate hikes also involve central banks paying out more interest on the reserves that commercial banks park with them. And that's tipped the Fed into an operating loss, creating a hole that may ultimately require the Treasury Department to fill via debt sales. The UK Treasury is already preparing to make up a loss at the Bank of England. And what is the issue here? We see that Britain's move highlights a dramatic shift in countries, including the U.S., where central banks are no longer significant contributors to government revenues. The U.S. Treasury will see a stunning swing, going from receiving about $100 billion last year from the Fed to a potential annual loss of $80 billion by year end. Now, what the issue is here is a political issue, because you can imagine Congress generally likes to spend money on their own projects. They don't want to spend money bailing out the Fed. In fact, they prefer that the Fed pay them. So all of a sudden, when Powell has to go to Congress and say, hey, we need you to write us a check for a change, you can bet the political winds and how people look at the Fed are going to change in a big way. The accounting losses threaten to fuel criticism of the asset purchase programs undertaking to rescue markets and economies. Most recently, when the COVID-19 shuttered large swaths of the global economy in 2020. Coinciding with the current outbreak in inflation, that could spur calls to rein in monetary policymakers' independence or limit what steps they can take in the next crisis. And now we're starting to get to the real story, because most investors still buying stocks because they believe, hey, it's okay if the market goes down. The Fed will immediately come back to the market and do QE, and I'll be made whole, and then I'll have even gains on top of that, as the Fed will be forced to buy even more bonds than they did, sending stocks to the moon. But what if the political tides have changed, because the Fed no longer contributes to Congress's bottom line, and Congress says, hey, next time we're in a recession, this QE thing is over. As for the Fed, Republicans in the past have voiced opposition to its practice of paying interest on surplus bank reserves. Congress granted that authority back in 2008 to help the Fed control interest rates. With the Fed now incurring losses and the Republicans potentially taking control of at least one chamber of Congress in November midterm elections only weeks away, the debate may resurface. So this is interesting, because most people don't realize that the Fed had no ability to pay interest on its reserves. And with the midterms coming, the question I have for you, and to weigh into comments: do the Democrats hold? Is it going to be a split, or is it a Republican sweep? Because if we do see Republicans take back power, one thing they could do is say, hey, Fed, instead of you actually running a deficit, why don't we do this? You stop paying interest on reserves, and we can make that happen immediately with a stroke of a pen. And what would that mean for the markets? Well, that means $2.2 trillion would need to find a new home. And what they're referring to is this overnight reverse repurchase agreement, where there's $2.242 trillion sitting there that the Fed is backstopping and paying interest on every day to people who are holding money markets. So if you have money in a money market fund, there's a fair chance that part of or all of that money is being parked overnight at the Fed. Well, that was a pandemic era, or a great financial crisis era, privilege that the Fed got to pay interest on that. If that gets stripped away, what happens is $2.2 trillion floods back into the T-bill market. You only imagine what that would mean. Well, it would drive rates on the front of the curve most likely negative, causing the entire rest of the Treasury yield curve to outright collapse on the way to zero. It would cause major disruptions in the banking system, but one thing it would do is actually alleviate the fact that the Fed would no longer have this problem of running a deficit. So who's running to the rescue, you might ask? Well, none other than former Fed chair, now Treasury Secretary, Janet Yellen. Yellen flags potential for buybacks of Treasury securities, noting the relative illiquidity in the 20-year bonds and that other nations conduct buybacks, so hey, we might as well too. It's something a number of other governments, including ours, have done from time to time, she said. I don't think it would be a main intervention tool we would use, but it's conceivable that something could be done here. On Monday, she noted to the Securities Industry and Financial Markets Association the Treasury is very focused on the Treasury market, as they should be. It's all that matters to the Treasury. Where there have been episodes of illiquidity where it's more difficult to buy and sell some securities, particularly in larger amounts, in recent years. And options under consideration include more central clearing. Many of the market-making financial institutions, i.e. the big commercial banks, would prefer an easing of regulatory constraints, i.e. the SLR rule, overseen by the Fed, that force the banks to set aside capital when they hold treasuries on their balance sheet. So what would happen here is that Yellen would issue more T-bills, which of course would then be used to absorb some of that overnight reverse repo. Of course, if that's the case, the Fed would have to lower the interest rate on that, which it could do. The Treasury, not the Fed, would then take the proceeds from those T-bill sales and use them to pay off old U.S. Treasury debt, and all they have to do is go out in the secondary market and buy it, and that would help Powell bail out of his problem just in time, indeed, if there is a flip in Congress. So you can see what's going on here is the Fed is well aware of its problem. It's well aware that Congress isn't going to like this and is looking for help, and the Treasury could be a big source of that pain, of that help. And now what we see is that Wall Street is betting that that's exactly what's going to happen. As Wall Street sinks billions into ETFs on both ends of the Treasury yield curve, as TLT and BIL funds have both now raked in $13 billion this year. At the same time, traders have sunk similar amounts into the iShares 20-plus year Treasury bond ETF TLT, a long-duration strategy. TLT has absorbed the most new cash of any fixed income ETF this year, despite historic losses spurred by the Fed's supersized rate hikes. So you have multiple factors here. Imagine what would happen to interest rates if indeed the Fed was forced to have to push all of this overnight reverse repo back onto the market, or if the Treasury did get involved in a buyback program, or they pulled the SLR rule off, or inflation came down. You can see Wall Street saying, hey, we know the probabilities of one of those is pretty good, and maybe actually there's a decent chance of two or more of those factors that could send rates, particularly on the long end, crashing. High conviction wagers on where bond yields will go next are hard to make between inflation still at a decade high, but we've made a case on this show that going into next year, that won't be a problem, and growing signs of economic trouble such as faltering credit and real estate markets. Some traders are potentially combining heavy positions in cash-like assets with exposures to long-duration bonds that are likely beneficiaries should the Fed cut rates in the event of recession, or even worse, be forced to send all that reverse repo money back out to the market, which would also happen if the Fed cut rates. And this is a key thing I want you to understand. If the Fed were to go back to zero, it has to lower the rate it pays on overnight reverse repo. So another solution here for the Fed is to lower rates, which of course Congress is not going to be opposed to at all. And if that was the case, again, 2.2 trillion sitting at zero would go run out to the T-bill market trying to get yield, and all of a sudden you see the problem start to resolve itself, and that's, you know, that would send the long end of the curve, those rates down, bond prices up, and now you see why Wall Street's positioning for that. On top of that, perhaps that foreign money is about to flow in a big way. As foreigners flee China stocks at record pace as rout worsens, the Hang Seng China gauge falls by most since the great financial crisis. Foreign sentiment on Chinese stocks is now low, as markets may need to wait to closer to the Central Economic Work Conference in December to see how the new leadership will address China's economic challenges. But where might that money go? Well, it might go to the one place in the world where Chinese investors can get a risk-free rate of return. We know that according to our chief strategist, Jeff Snyder, that foreign investors are selling U.S. stocks to buy U.S. bonds, but perhaps they might start selling foreign stocks to also buy U.S. bonds. And why might that be? Well, because higher interest rates will the market say take time to bring inflation down? Well, I think this is where the market's wrong. And of course, we see these traders perhaps know what's coming. As higher interest rates can take a long time to bring down inflation, this article on the Wall Street Journal says they have raised rates this year at the fastest pace in decades, in fact, fastest in history as far as I can tell. But those hikes will work with what economists call long and variable lags, a case we made not only this show, but at the recent Trader Summit conference. So central banks might not know for years if they have tightened too much or not enough. But Milton Friedman has said that these long and variable lags range in 6 to 12 months, meaning we're right midst of that window now. We're in the middle of that 6 to 12 month window because the Fed started hiking back in January. Why the lag? Well, interest rate changes filter through to inflation in a series of steps as the short-term lending rates controlled by central banks steer other borrowing costs in the economy, including deposit and lending rates for household and businesses, with a delay because loan contracts take time to change. But higher borrowing costs and lower asset prices deter households and businesses from borrowing and investing, which weakens sales and the ability of companies to raise prices and workers to win raises. And this is a point I've made as we head into the holiday season. Will consumers look at their credit card balances, which are now at record high, and see that they're being charged very high interest rates, have a high minimum payment, and choose to pay down their credit cards instead of hitting the stores to do Christmas shopping? If that's the case, then what we're looking at is retailers and wholesalers seeing a ton of inventory going into next year, and that won't be good for earnings. The International Monetary Fund said this month that interest rate changes have their peak effect on growth in about 1 year and inflation on 3 to 4 years. Well, let's challenge that immediately as we look at this chart here with the 2-year Treasury yield in red against the consumer price index in blue on a year-over-year rate of change. And we can note that when the 2-year yields start to fall, inflation is either soon to peak or already has peaked. And so the idea that we're taking years to get through this is highly unlikely. The moment you see 2-year yields come down, you know the inflation story is over. And lags create the risk that central banks might ease off the monetary brake too soon. That is because people start losing their jobs months or years before inflation returns to target. Let's challenge that one as well. And the answer is it used to be the case, but now when we see that unemployment claims start to bottom and turn higher, that the peak in inflation is not far off. In fact, they oftentimes now coincide with each other, with the exception of the great financial crisis. And with that, lags carry the opposite risk too, as central banks might hold interest rates too high for too long, past the point when economic output is already weakened enough and the hope for decline in inflation is already in the pipeline. A case that I've made is, and this is the reason we see that the central banks always go too far and are playing chase the other way down, why I think rates end up back at zero much faster this time than ever in history. But the issue is Congress is going to have to bail out the Fed, who's on the hot seat. They're going to have to make some changes, and changes soon. Perhaps Janet Yellen will be the bailout mechanism. Who knows? But all we know is it won't be long before the Fed is standing before Congress answering of why it needs a check. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.